All right, Keelan, what do you got today for Money Chat?
Well, coronavirus, craziness in the market, the Fed drops by 50 basis points. I feel like because we're in the mortgage business, I don't want to be subtle about this, and I'm going to have no shame in this. Call me and Tina if you have... like even 4% rate right now. Rates are so ridiculously low right now, like historically low. People, if you're listening to this and you have a mortgage, you should be calling an expert, preferably us, to talk about your mortgage needs.
We are your local mortgage experts.
Exactly, and you definitely want an expert because it doesn't always make sense to refinance because there's cost to refinancing and you have to do the math, and not everybody does fair math. There's some funny math in our business, so don't get caught up with the funny math. But the reality is it does not hurt or cost any money to look and see where you're at, because I think, and I think any expert would agree at this point, rates could be a whole lot higher. How much lower can they go at this point? So I think risk versus reward. I mean, lock it up. Lock it up. It's a good time right now. Make sure that, something could happen pretty quickly in the market. Rates could jump up pretty quickly. But the downside of that, I don't see how much lower. How much
lower could they get?
We don't have a crystal ball.
Crazy.
I think they will go lower. They can't go lower by a whole lot more.
Well, I just locked a client in at 2.875 on a 30-year fix. Now they pay points. And, I want to make a comment on what you said, Keelan, because, what majority of mortgage professionals do is they just don't provide all the data, not because they're intentionally doing it, because they don't have the tools to do it. When I started in the mortgage industry back in May of 1995, there was actually a refinance boom that was coming in there pretty quickly, and there was nothing available for me on the market to analyze what it really did to make sense. I was having to do all these manual calculations, look at one tool for this and one at that. You may know as a regular listener that I'm actually a mortgage software owner. I'm founder and owner of Mortgage Triangle Software. And the why behind creating the software was in this market many, many years ago. And now it's a full-blown software that other mortgage professionals can subscribe to. But in what Keelan mentioned there is all you need to do, there is multiple cost structures. So when I'm educating clients on loan options, Keelan as well, we're showing 5 cost structures. You can do a no closing cost refinance, no cost at all. You're going to take a higher interest rate all the way until my client that I just recently locked in at 2.875 paid additional points to get that interest rate. Now, what you want to make sure that you understand is you have to compare your current amortization schedule to your new amortization schedule. And that's what my software does, is we can, within minutes, run an analysis of exactly where you're at in your amortization schedule today versus where you're going to be starting in a new amortization schedule. And if you take that payment savings and apply it towards principal or not, what does it look like? What is the difference in the interest paid and the current ending balance, depending on how long you plan on keeping the loan? I mean, it's a green or red result.
It either makes sense or it doesn't.
It makes sense or it doesn't.
Don't know and you missed the boat, I mean, we're talking about history here. Chances are, if you lock your rate in right now, we may never see these again for a decade plus, maybe never again. I don't know. I mean, we're getting there. So.
We're getting there. And, a good follow-up on Keelan, you talked about the Feds. I'll go in a little bit more detail about what's happening with the Federal Reserve, lowered the target rate range from its federal funds rate by 50 basis points, is what Keelan mentioned, to 1.1% during an emergency move on March 3rd, stating that the coronavirus poses risk to the economy activity. Now, the Fed is closely monitoring developments and their implementations for the economic outlook and will use its tools to act appropriately to support the economy. It is the first emergency rate cut since the 2008 financial crisis, although markets were already pricing in the cut of the 50 to 75 basis points in the next meeting on March 18th. The move follows a G7 announcement made earlier in the day in which policymakers reaffirmed their commitment to use all appropriate policy tools to achieve strong and stable growth, although failed to provide specific actions. Now, the interest on excess reserves rate was also cut by 50 basis points following the 0.5 basis points raise in January. Now, most consumers do not understand when the Feds lower the prime rate, it does not have a direct impact on mortgage interest rates. The prime rate does impact the Fed's fund rate and is used to determine the cost that banks will lend to consumers for short-term loans like credit cards, car loans, home equity loans, line of credit loans, and personal loans. These loans are directly affected by what the Feds do with the prime rate. Mortgage rates, on the other hand, are based on how the bond market is trading, and they're actually directly tied to the Fannie Mae 30-year bond. That's important to know, as mortgage rates are not tied to the prime rate, but instead to the bond market. So when the Fed's role, what their role is to stabilize prices and employment. Their role is to manage inflation and maintain a balanced market. So if the Fed's decision to lower the prime rate slows down the economy, this is good for mortgage interest rates. If by lowering the prime rate, the economy speeds up, this is bad for mortgage rates. So if there's consumer confidence, investors are going to invest in the stock market, even though it's a higher risk because of the potential higher earn on investment. If there's lack of consumer confidence, then investors are going to pull out of the stock market. They're going to go into the security of the bond market. Bond trading prices are going to go up and mortgage rates are going to go down. So normally, if you look at the stock market, the bond markets are working opposite of the stock market. So just a little bit of education on prime, because it's interesting, even in the media, Keelan, you'll hear the media say, the 0.5% lower in prime rate, it's a great time to look at mortgages. And so it's kind of deceiving because consumers just think automatically that mortgage rates have gone down. And if you look at, there's charts out there, you can look at the difference between the prime rate and mortgage interest rates, and you can see many, many times where there's an opposite movement between the two rates, because mortgage rates are not directly tied to prime. Everything is affected by what the Feds do with the prime rate. So only time is going to tell on how the markets are going to react. But every month, all eyes turn to the Fed to search for the clues in the language that they're using to try to determine when the rate increase or rate decrease may come and how much it's going to be. So depending on the market's reactions, the Fed will determine their next move.
Yeah, I got quite a few calls from the 50 basis points drop. Mm-hmm. But also another point to be had is that a lot of the banks build in a little buffer too. So we might not see a change at all in the market, literally none, when some of these fluctuations happen. So it just depends. And I hate to use that word, it just depends, but it just depends.
It just kind of depends.
But it doesn't hurt to find out where you're at and making sure that your mortgage is always in the best possible position it can be in.
Great advice, Keelan.
You too, Tina. Caught me off guard there. I didn't know what to say.
Sense a little bit of love here with the host and co-host.
Always.
All right, coming up next on The Money, our rental market legal update. Corey Brewer and Rob Gaska right here at 1150 AM KKNW after this short break.